Maceo, how you doing this morning?
Ryan, I'm doing fantastic, especially because I know what we're going to dig into. This is going to be a good one for your audience, man.
I'm excited. You had a company that reached out to have you on my show, and I'll tell you what, 1 out of 50 actually is worth it. And so I saw your bio, I was like, hey, this is going to be fun. And I'm assuming with the online space you've been on and been in a couple other industries that if we were to spend some time, we'd have a lot of common acquaintances that we've got.
Oh yeah.
And so let's just get us caught up to speed on what's your background, the businesses, and then we can kind of unpack the different parts of the journey along the way.
Well, I'll start with, I think, what's most relevant for the audience today. I got started selling online in 1993, 1994, back when it was just IRC chat. So there was no Google, there was no pay-per-click. Transition out of that was trading in the hedge fund world for a long time, developing algorithms and computerized trading. And then fast forward to around 2005 is when I got back into, I'll call it full-time marketing, if you will. And so digital was still really new back then. There was no unified video players. I mean, it was the Wild West, man. But I had the good fortune of growing a company from a $25,000 loan to just under 50 million in revenue. We hit 23 million in just a few years. But it was really the culmination of all of my experience to that point that enabled me to execute on that. I exited that company in 2012 and spent a lot of years working with entrepreneurs. I mean, that's where we connected, because I just couldn't understand why more entrepreneurs, especially in the technology space, were not creating something that they could go sell. I mean, they just either they didn't get it, meaning they didn't get the process. They didn't really understand what the value was. Like, why should I do it? Because it's not falling off a log. You and I both know that. So I've got a lot to say about, that, because I've worked intimately with entrepreneurs. I've even taken on my own dime, gone into companies to find out, could I go into a company and get them thinking about an eventual exit, change it from the inside out. And so I've got to tell you, first of all, the bad news is no, right? The entrepreneur has got to get this at a DNA level. But anyway, so it's been a wild ride. I'm a crazy mad scientist. I've tested a massive amount of stuff. One of my philosophies is, I'm never going to tell somebody to do something that I haven't tested with my own money. And if I am going to experiment, even if I'm a consultant, then I'm going to pay for it. I refuse to let a client test something just because I read it in a blog somewhere.
So it's because I listened to a little bit of one of your interviews for the different podcasts and your high frequency trading. So I'm going to dip into a different dimension for a second. So
yeah,
huge fan of like Ray Dalio, Flash Boys is what I thought of when I saw your bio. And I was like, oh my God. And so the reason that all came to mind is Skin in the Game by Nassim. And you actually mentioned Nassim Taleb.
Yeah.
Read all these books, man. So I think there's an interesting intersection of business and then like understanding the markets and money, but that also like value. So
right.
There's an interesting kind of crossover, like a couple different worlds.
Well, dude, so as a trader, what you learn very quickly is it's not about you. I don't care if you're managing $50 billion, you cannot move the market for very long. And so what every successful trader realizes at some point is you need another buyer and another one and so on, to take price up. Some people might call that a trend. There are ways to manipulate it. I mean, that's kind of what I did. I was at more of a market making firm, and our job was to manipulate price. But even with that, it was all very short lived. Right. So our job was to come in when somebody wanted to exit a big position. So we were there to create, actually the real term for it is called foment. We were there to create an environment where big orders would come out of the woodwork. And so what traders intimately know that entrepreneurs don't is value. I mean, the stock market and the futures market is 100% about value because it takes a willing buyer and a willing seller. I mean, I've seen guys, even on Microsoft, a big symbol, sit on the bid or the offer sometimes for 20 or 30 minutes. Why? Because nobody was willing to take their offer, or their bid. So say they've got 50,000 shares that they're trying to get out of, like fill or kill, which fill or kill, if you don't know, means somebody needs to come and take all 50,000. And so I remember I got in an argument with one of the guys I was trading for. He was trying to exit 50,000 shares of Microsoft, and it was always fill or kill. I'm like, Steve, what are you doing, man? Sell it 5,000 at a time. Well, I might not get my price. I'm like, you're not getting any price now, are you? And he kind of sat there for a second. He's like, yeah, you're right. But that's a perfect example of the value was in his mind, and it was Microsoft, right? So nobody would argue that, Microsoft stock has no value, right?
Right.
But to that one trader at that moment, it literally had no value. He couldn't sell it. And so when entrepreneurs are thinking about their company, it's the same thing, man. You could be sitting there on the bid for 5 years trying to sell your crappy company, and everybody's like, nope, I'll pass, I'll pass. And all day long, what do the entrepreneurs say? Why isn't anybody buying this? I know my company is worth X. Dude, the marketplace is telling you zero, right? So let's turn things around. Let's find out what the market actually values. And so even on something like Microsoft, which you would think, oh, this is a really liquid stock, I can get rid of it any time. No, I mean, mostly you're dealing with, 1,000 lot, maybe 2, 3, 5,000 was really about the most you could reliably get off on Microsoft, but certainly not 50,000. It wasn't working.
So I think that's huge and fundamental for a foundation as we
Yep.
progress your story too. And it's just interesting comment on that. And so is that after we sold our business and I realized how the market, like what actually goes in your pocket afterwards and all the options.
Right.
I got into wealth management for a hot second afterwards, understanding what to do with the money, got my securities license. And then I kind of shifted my mindset into the world that you're talking about. So it was the different order, but like,
Right.
that's when you kind of like realize that private business is the same thing. How did
Yep.
this translate into your business, and what was maybe give the listeners a little bit of an overview? What was the business? Why did you start it? And maybe or like what was the opportunity?
Yeah. So it's a funny story. So coming out of the 2000s, I was actually a street preacher for about 5 years.
No way.
Yeah. And I was constantly, I just wanted to do what God wanted me to do. And I kept getting drawn back into business. And finally, in 2005, I said, well, Lord, if you want me to do this, it's going to be hugely successful. Otherwise, I'm just going to go clean toilets or something. I don't know. And so that in 2005 is when I refocused back on
What is a
business. But
street preacher? I got. Sorry, I can't get. I know
yeah,
what
I
a
mean,
preacher is. I know what a street is, but those two combined, I have not heard.
just basically preaching on the street. So talking to just everyday people about,
Yeah,
the gospel and Jesus, man. I mean, it's,
that's awesome.
yeah, we were pretty out there. I could tell you a million stories about that, but I
So
digress.
you're out there selling the truth, man. Like so you.
Yeah, that's right. Yep. Amen. So it was right at the beginning of what we now see as quote unquote digital marketing and e-commerce and all of that. Amazon, of course, had been in the headlines forever, but they were still losing a crap ton of money. Nobody had really figured it out. But the real issue, striking to the heart of what I learned as a trader, is that there wasn't a trend to jump on. The average person back then still really wasn't comfortable with putting their credit card online. The formatting wasn't really right. So, if you couldn't really see, I mean, for the few people that had a screen to buy on, you couldn't really see it. And saying that, we didn't have mobile phones, right? So you didn't have internet everywhere. So there were a lot of
Next
things
to
that were going
walkie
on.
talkies. I'm just thinking of like the exact timeline to say where like you have like the company cars that are like www dot like you have to like the car is telling you to go
That's
online.
that's right. Oh man, and you got to remember back then, Bill Gates was still like, this internet's just going to be a passing thing. Yeah, I mean, people did think that it was going to facilitate commerce, but nobody knew that it was going to be what it is today.
Yeah.
So I jumped in it and looked at it more as a medium, like a marketing medium, right? So I'm very much versed in direct response marketing. So anyway, in 2005, I tried a bunch of different stuff. And it probably shocks people to know I didn't jump into the financial world right away. I was talking to a trading mentor of mine. His name is Larry Pesavento, and he said, "My boy, you need to start a newsletter." And I was like, "What the heck is that?" So we talked about that for a little while. Of course, today they're ubiquitous, right?
Right.
It's like info marketing is ubiquitous online. And so I happened to be in those early days of information marketing when the internet was accessible to entrepreneurs as a medium for selling info products. And really, because of the mechanics and the economics of info marketing, digital marketing is very attractive. You know, we were selling through the mail, right? So you've got to spend 50 or 60 cents on an envelope. It's actually about $1.20 when you looked at all the printing. If you really wanted to get somebody's attention, then you were looking at FedEx, which, you know, then you're looking at $13 to $15, you know, just for the envelope and the postage.
Mm-hmm.
And so we looked at digital marketing as being more capital efficient, which it was. So that's why I gravitated to it as a main issue. But then I also saw, you know, hey, this is on computers. When I looked at Google and the pay-per-click engines, I said, man, this is just an auction market, which is like the stock market. You know, so I said, there's got to be a way to use some of these bidding algorithms. And I applied a lot of my more short-term trading theories and tactics to pay-per-click very successfully. But really, the bulk of what I did was in applying the same trend thinking from the markets to business, which was my way of constraining risk. Right. So the biggest risk in as an entrepreneur is that you're going to sell something and you're not going to have enough buyers to relieve you of all of your inventory. Right. So entrepreneurs, we all make money on turning capital, no different than a trader. You know, so people tend to gravitate towards day trading because they think, man, if I could turn my capital over 50 times a day and every time I did that, I made $100, I'm going to get rich. Well, look, that's all Walmart's doing. They're taking their money, they're converting it into a product, and then they turn that to consumers. And so obviously, if you have more and more retail locations, you can turn more product, which means you're turning your capital, right? Capital turnover. I mean, let's get down to the basics.
Mm-hmm.
And so when you look at business, if you're putting your capital into something that doesn't have enough of a trend behind it, you're going to be stuck with your inventory. You know, think Cabbage Patch Kids, Beanie Babies, you know, these things that were these massive fads, massive trends for a short amount of time, but then they reached the cliff or the waterfall and demand basically went down to zero. And so that, you know, as an entrepreneur, we've got to think about our company, our businesses as a capital turnover engine. Our efficiency as an entrepreneur is going to reflect how much of that capital are we retaining as we turn it over, right? Those are the dials that you can turn inside of the company. But the main driver that everybody skips is the dang trend. I mean, even, you know, so even in cell phones, right? The thing that's rough about cell phones is we're coming out with a new model, what, every year now, basically?
An iPhone's an iPhone. The camera there.
Right. They're selling a different camera, basically. But so if you look at your whatever it is that you're doing in the context of the trend first, and then you can take care of the guts of the company, the capital efficiency second, you're going to find the risk in a business, the risk profile is considerably different. And so
I was going to say, so there's a couple comments I want to, because
good.
I want to get into your business too and how this all applied to your business and then all the companies that you work with too. But I want to kind of like link up a couple of important themes that you've touched on, and I want to hear your input on it. So what I find interesting is that, so you're talking about trends and you're talking about capital turnover, so the cash flow of that.
Mm-hmm.
But then, so what's interesting is how you're looking at trends and strategy, but then also because of your background in trading, you understand value. So like, just because you have cash flow, that doesn't mean that it's got high enterprise value. So as you're kind of weaving this together, Maceo, just talking about like the risk of the cash, because in our training, what we do, some context behind it is we walk through the buildup of the discounted cash flow. Company specific risk is the biggest variant, right? Mm-hmm. So just kind of weave that in as you're talking about capital turnover and trends. A lot of people aren't looking at trends and they're not looking at a couple of these key components. They're just waking up and grinding away. Like they just grind and they just aren't looking up.
Well, so let's, because of my trading background, I'll try and make it simple and practical at the same time. So every SaaS, so SaaS, if you don't know, is software as a service, right? So you're going to code a bunch of stuff up. And of course, the adage is there, why do I need your crap instead of a spreadsheet, right? So let's assume that you have an idea that's better than a spreadsheet.
Really expensive GUI, right?
Right. By the way, it's probably not, which is part of your problem. I hate to break it to you, but let's say you do have something that's actually going to work. Where most people go wrong is in understanding that your solution is running to obsolescence, right? So The magic isn't thinking, where's the market going to be 3 years from now, 5 years from now, which is also why it's really tough. The way around all of this, again, thinking about value, is going to a smaller market. So I'll take this all the way back to the old days when we used to actually trade person to person. So a bunch of people screaming in a pit, yelling, like this, and hand signals.
The boiler room.
Oh man. So inside of that pit, let's say it's the S&P 500, right? So everybody knows the S&P 500 who's looked at the stock market. Again, it's very liquid. It's not lumber, it's not Beanie Babies. Inside of that huge pit, you could have major price discrepancies. And it's because in that small physical area of the pit, somebody walked in with a huge order. It's that simple. And so even though you've got this massive market that's out there, so that could be SaaS, it could be just internet, it could be retail, it could be cell phones. If we think about it in that way, like we have this big marketplace, where do we find these small concentrated pockets of value? So if I know, it's called, in the old days, we called it paper, right? So if I know paper's coming into the pit, that's a Goldman Sachs or, Solomon Smith Marty back in the day, with an order to buy or sell, say 1 million contracts. That's a lot. And I know for a short period of time, you can eat a lot off of 1 million contracts, but it's going to end, right? It's not going to take 6 years for that to play out. That's where entrepreneurs miss, is they don't really dig down from this huge space that's their market into the pocket of value. So let's say you go into auto dealerships, and not even that, let's say it's auto parts stores, and you realize there's lots of mom and pop. They don't, have no way to aggregate any of the inventory. They're either calling people up or, going into a book and looking it up. And so you go in your SaaS solution, which is going to be better than a spreadsheet, is yes, it's the spreadsheet, just organizing parts and what's the item ID and the price. You can do that with a spreadsheet. But if you link them up to some national network, it's like, okay, wait a minute, now we're talking. Well, why is that? Well, it's because the internet gives us the ability to connect more pockets of value. That guy in Tupelo, Mississippi, all by himself, running his parts store, has very little value. 5,000 of those guys have extreme value. Now, when you start chunking that up into, discounted cash flows and really getting into the nuts and bolts of it, you're going to find you have at least something to work with when you eventually start talking about who's going to acquire you. So I'll jump over all of that. So where I typically go is, okay, have I found a pocket of value, to who's going to buy this pocket of value that I've concentrated? Now that is, when you think about exits and strategic buyers versus private equity funds, that's the secret sauce, is when you jump from your business nuts and bolts to selling those nuts and bolts, you can look backwards at it with a completely different set of eyes. And you can start to understand what that eventual buyer is not only going to want, what they are going to value, and more importantly, where you can sell your company for more money. Because look, we can all go in and say, well, company X is worth 3 times EBITDA or 5 times EBITDA, or it's a tech company, so it's 15 times. Well, no, I'm working on a roll-up right now where we can actually make a case for 30 times revenue. Well, how do you do that, Maceo? Well, you do that by, number one, finding the pocket of value, and then going and investigating the people that you're going to target to buy it and understanding what makes their business work, and then designing your company, reverse engineer your company to provide that, like in a legitimate way, not like it's just bolted on.
No, and what I find, and I'm curious, like when you're talking about finding that pocket of value, given the fact that the US is like what, 72% consumer-based economy. And this goes back to the understand the markets, right? You're going, okay, well, people buy, shit. People wake up and they buy stuff every day.
Yep.
Who's buying what and why? And it's usually to make themselves feel good, eliminate frustration, period. Right. And hopefully those people have money to buy shit. And then what are the industries that are riding that wave? And if you think about, like, it's all starting from margin and accumulating capital in those trends. It's like,
well, so I'll open up the technique that I use to discover trends. Well, actually, let me just talk about it practically. So when I was looking around at all these different businesses, let's go back to 2005 in our brains, where I had a lot more hair. It actually was a lot bigger. I was, more of a power lifter back then, which, I'm kind of missing at the moment. So it's back then, right? So you're seeing this muscle-headed dude walk into a library hour upon hour every day. So why did I do that?
In between street preaching too.
Well, no, this is when I transitioned out of that. So yeah. So I wasn't doing that anymore. So it's like full time. I literally had 25,000 to my name. So let me make that clear. It wasn't like I had money coming in. We were eating off of that 25 grand at the same time. And so I went in and looked at something called the SRDS. Most libraries still have it, although they're not used as much. But that was the data aggregator for all of the newsletters and stuff that was sold in direct mail. Now, the reason why I went there is because in order for them to provide value to advertisers, they had to tell you how many people were on the list and what was their average purchase price. Well, dude, if I want to know how much people are spending, I'm just going to go look. This is why one of the things I don't like about what's going on now in the digital world is they don't expose that information very much anymore. So anyway, I went back. I was going through the SRDS. I got into the financial section. I found there was about $1.5 billion, so $1.5 billion being spent every 90 days on financial newsletters. I said, well, dude, that's a lot of money. I mean, certainly I can roll around in that kind of a pool and have some of it, stick to me. And so that's just a practical example of one way that you can do it is go out, find as best as you can where people are spending their money. So you can go into tools today like SimilarWeb. AdBeat is another one where you can, at least from the advertising side, see where companies are spending their money. Granted, they're not going to tell you how much, what the customer acquisition cost or what their average purchase price is, but you'll at least get some of the data. And so that's one way to do it. The other way is just listen for problems. What are people complaining about? And then talk to those people and find out, well, is this something they're just complaining about because they feel like they need to complain in that moment? Or is it a real problem that they have in their business? So that auto parts store, the question would be, well, how much or how many times a day or a week or a month does somebody come in, ask for a part, and you have to tell them that you don't have it and you can't get it like in a reasonable amount of time? And you're probably going to find in some cases it's a lot, especially when you start dealing in specialty parts. So this is where the beauty of the internet is you can aggregate the long tail, right? That's the real power of the internet. The real power of Amazon is that Jeff Bezos saw early on that you could aggregate the long tail. The name of the book is escaping me. Jeff Bezos has actually written up in it. I'd almost go find it and let you edit it out. Anyway.
The everything store?
No, it's earlier than that. This is like 92, 93.
Okay,
yeah, right. I mean, it was the second edition in 92 or 93. Anyway, so what that book was saying was that, this is how sometimes the academics get it right. What the academics were saying is, hey, this internet thing is going to aggregate all of these small markets to where they're at least accessible, right? So if you are going to start something in the digital realm, when you start with that premise, what long tail, and if you don't know, long tail just means you've got, instead of one big market where people are spending, say, $10,000 per transaction, you've got 10,000 people spending $100. But here's the key, that $100 is not a maybe, right? It's not Netflix where I could read a book or go to sleep or take a walk. It's like, if I don't spend that $100, I'm in trouble, or I'm losing something important in my business or in my life. That's the power of the internet. And so when you look at it that way, you're not stuck on, just that one outlet, which means you may only see one or two examples of it in your town or somewhere that's near you. Your job then is to go out and figure out, well, how many of these people are there? Another way to do it would be to go to, a list broker, Info USA. You can do it relatively cheaply and just do a search. Well, how many businesses fit that one category? And they're going to let you sort it by, revenue, employee size. So you can get a ton of information absolutely for free before you even start, which, by the way, is everything. Most entrepreneurs, the big mistake they make and you alluded to this earlier, Ryan, is they just jump in like, oh, I have a brilliant idea. I love my idea because it's my idea and I'm going to go make $1 million off of it. And then they go spend, their life savings, their family's life savings, only to find out 5 years later, it's like, oh, wow, well, we lost money. And then, a smart aleck like me comes in and says, well, yeah, duh. Like I could have told you that in 30 seconds, which is, why I'm that messenger that gets his head lopped off quite a bit, only because I've got that different perspective. So I come into a company looking at it in reverse. So I want to say, okay, well, where do you people want to end up? Do you want to end up with a company that cash flows and you eat off of the cash flow for the rest of your life and dump that into other stuff? Do you want to, build something up, build up enterprise value and sell that off? You have to start with your end in mind in order to get there, right? So we don't.
And end from a couple different things that we were talking about, which is the trend and the strategy,
Yes.
but also making
Yes.
sure that at the end, it's not something that is just revenue, but it's actually got enterprise value. Right. And so like, as you're continuing the story, Maceo, is like, I'm curious, like, so obviously insanely important when you start a business, right? Like start with the end in mind. It's so Stephen Covey, it's so like, I think
Right.
like out there that people kind of get numb to it, but it's so true based on what we were just saying. But how do you deal with someone that did the idea, had an opportunity, their clients started them off into entrepreneurship. Now they got a $2 million business because the opportunity just forced them into it. Or they start without doing this research and they're in their journey, Maceo, and you got the sunk cost fallacy going on. And you're going, it's going to work, it's going to work, it's going to work, it's going to work.
I wish I had good news. It's so I'll dovetail this into one of the lessons that I learned as a trader was around mindset. And so the average is trading is 90% mental. As my career got towards the end, I shifted that to 100%. Entrepreneurship, trading, it's 100% mental. As a business owner, you have got to look at things as they are, not how you wish them to be. And it's so tough when you've spent hours and hours. I mean, this is, we refer to our businesses like our kids, right? This is my baby. First of all, no, it's not. The employees that you think are so loyal, they'll leave for more money. They'll leave for better benefits. They'll figure it out. It's like, we don't have to be so concerned about those particular things. Now, I'm not advocating for, like just cutting people's heads off, but that's just the reality of it. And so I'm also, by the way, I'm also a huge proponent of overpaying people and rewarding people with stock options. The main reason why I do that is because that's the way you keep them. It's like that way they don't get a better offer and you lose your best people, duh. But so the place to start would be, what is the market really? What is the life cycle of your customer really? So I'll give you an example. I'm not affiliated with this company. It just came up in one of the Slack groups I'm in. It's a company called Videos, and it's around video stuff. And we were having a discussion around selling a lifetime package. My point was, first of all, if that was going to be a successful tactic, every VC-backed company in Silicon Valley would be doing it. And I can just say it's a dumb idea because none of them are doing it. But let's dig in, is what I said. So what you wind up sacrificing by selling a lifetime package is some incremental future revenue. Now, the guy said, well, I can just sell upgrades. I said, true, but have you looked at how many of your lifetime buyers bought your upgrade? And he said, no. And I said, okay, well, then you're assuming, this is the key point. He was assuming he could sell them an upgrade, but he said it like it was a sure thing. That's an important thing not to miss. In his conversation, he was reinforcing his already done belief that he was okay selling the lifetime revenue because at some future point he could upgrade them. He's not looking at the way things really are. He's looking at them as he wants them to be. Now, there's a lot of cognitive biases that go into this. It's really worth some study. MIT has a great behavioral lab. I narrowly missed going to MIT. Out of the Army, I got accepted, but I never went. But they do really good work in their behavioral economics. And I'm telling you, this is the enemy of entrepreneurs. As soon as we get an idea, we think it's the best thing in the world. What we miss is the longer we stay in that headspace of this is an awesome idea, fast forward to the company Videos, I think it's 3 or 4 years old. They've now pre-sold a massive amount of revenue, but they've also conditioned their customer to think, I'm a lifetime client. Now, I've tested lifetime revenue deals. What you wind up putting into somebody's head is, oh, then I get everything for free. It's inescapable. You can't sell around it. If you try and sell around it, they're going to be pissed off. And then they wind up just leaving the platform and saying, well, I'll just write off the lifetime money that I gave them. They cut off their nose to spite their face. Like, well, he's a jerk. I'm just not going to use his product. And so let me not get caught up on the lifetime value. It's the mindset, right? So you've got to be able to look at where your business is now. Say it's a couple of $1,000,000, like Ryan said, it's grown. You're kind of in the grind. Your head's been down for a long time. And now you're just poking your head up and looking around. The best thing you can do is focus on data. What do we know and what can we measure? Some key questions that I ask: compared to what, and how do you know that? All you have to do is keep repeating those annoying questions, and you will, I'm telling you, it's just like Novocaine. Give it some time and it'll work.
For all the people and the misinformation going out these days.
Oh my gosh. Well, yeah, I would get into some pretty heated conversations. Like for example, somebody saying, "Oh, you should split test the color on your page." That's a complete waste of time. And so if you dig in, you say, "Okay, well, how do you know that? How do you know that? How do you know that?" What you eventually find out is they tested it on 150 clicks, 7 years ago. And based on those 150 clicks, when they stopped the experiment, they went from making $5 to making $10 and they're telling you, oh, 200% improvement.
Their social currency of like their word of advice that they want to give out.
Oh my gosh. So those two questions as the entrepreneur will serve you to get to reality. Look, we're not trying to make it personal. We're not trying to insult anybody. All we're trying to do is figure out what the hell is really going on.
100%.
Yep. And so that will help that person. So the person you just described is ask those questions of your team, ask it of yourself. If you're alone in your office, write it down. So, if you're taking notes, okay, so how do I know, and then fill in the blank, how do I know my lifetime value is $500? Well, I don't know. And then write it down. How did you calculate it? Go in and look on what customer cohort. If you don't know, cohort is just a group, you have 50 customers that bought in May of 2012. That would be a cohort. So did you use any of that information? So it will force you to get to the reality of what's going on eventually. I mean, if you ask it enough. I mean, in the trading world, there's just no time for bullshit. Like, you cannot let somebody's opinion push buy or sell. I mean, my goodness, you're going to lose a massive amount of money. And so a lot of this, I'm steeped in this, mostly through embarrassment.
You touched on an interesting concept too, like on the trading floor, it's not about opinions, or not about, was it opinions that you just said? Or
yeah.
It's so synonymous to, like, in the private world of M&A, you have the people that are buyers, where whether it's a strategic buyer or whether it's a private equity firm or VC, whoever it is, they're approaching it like you just said, and the owner's going, "But I started this in my garage and I risked my 401k," and they're going, "What's the risk of the cash flow, sir?" Or ma'am.
Right. They don't care. And this, look, we're never going to separate our emotions from what we're doing. And that's actually what a lot of people don't know about traders is they're very much into mindset. They're very aware of their emotions. And especially the successful funds will make you see a psychologist, for this reason. Like, you've got to get a real handle on your own emotions before they're going to allocate a bunch of money to you. But it's not enough to just say, oh, it's just business. Realize that it's not just business for you, the entrepreneur, going into the situation. The way around it, and this comes straight out of trading, is pick your target. What do you want to make for your company? Write that down. But then also be open when you start getting feedback that says, maybe that's too high. Obviously, if it's too low, you're going to get people, saying yes to your offer very quickly. That's obvious, just raise your price. But if people are saying no, or if they're giving you pushback, or if you're not getting, calls back, if it's taking you months and months and months to sell your company, because I'm in the middle of 2 different roll-ups right now. I can tell you, it should not take you a year to sell your company. It really shouldn't even take you, multiple engagements to sell your company. It's because you're coming back to price and terms, right? I'll pay you $1 billion for your company. It's $1 billion, $1 a year for $1 billion years. right? So it's price and terms. But again, it's looking at it from what's really going on. What is your buyer willing to pay you?
And why?
And exactly, and why, most importantly. And so do some due diligence. If you're selling to a PE firm, look at their portfolio. Go to a conference where they're speaking, or get on a Zoom call. Listen to what they're saying. What do they want? What's their philosophy? What kind of rates of return do they want? And you're going to know with beyond a shadow of a doubt whether or not you even fall into that realm.
Well, I think that's the big difference of PE firms compared to a normal entrepreneur is they have the investment thesis that drives everything that they're doing.
Yes.
They're like not many entrepreneurs come up with their investment thesis, which is just their strategic plan. I think about our old business, Maceo. It's like we're in copiers and print. Like that's not really booming upwards, right? But there are PE.
What a great business, man.
Back in the day, man.
Yeah,
that's
right.
all I grew up hearing. Back in the day, there used to be lots of margins. Well, there's not anymore. So what are we gonna do about it? But
you want toner? That's $500.
Yeah, exactly.
Like pouring it into the thing. That's how far back I go, man. Oh my
there
goodness.
used to be fire extinguishers on the copiers just to make sure that.
Yeah.
But my point is like there are PE firms in the space right now, but they have like a similar investment thesis of like Blockbuster, which is all late fees. The company's never coming back. Let's ride the ship right into the ground. But they'll still ride it into the ground, making a 21% rate of return.
That's right.
Like,
yep.
It's just like there's a reason behind the entire endeavor.
Well, that's the main reason why I tell entrepreneurs you have to start looking at venture capital. You have to start looking at private equity, is because they can't dick around, man. They have to have a plan. Nobody in the world is going to drop. The reason I'm getting so excited about this is because people talk about closed markets and there's no opportunity. Look, it's not just that. So I had the good fortune of going through Special Forces selection. I wasn't selected. I was never a Green Beret, but I made it through selection, which that's huge. Not many people do. The reason why Special Forces has selection is because they don't want every schmuck off the street coming in and handing them a gun and kicking them out the back of an airplane. So no rational person is going to spend the decades it takes to amass 30, 40, 50, 60, 70 million in cash and then drop a couple million on you without having a selection program. That's Yale, it's Harvard, it's Stanford. Now I'm not big on education. I'm just saying that's their shortcut. So they know, okay, if you got into Stanford and they're going to call some of your professor, they find out, okay, you weren't a total slacker. It's like, okay, they at least know something about you.
Mm-hmm.
That's enough of that. So, but the reason why more entrepreneurs have got to start studying venture capital is from the investor side of things, right? So you want people to go through some kind of selection process. Why? Because it's tough to amass $30 million in cash. It's tough to amass $1 million in cash. Just think about, the basic, let's call it average margins of a company, say it's 8 to 10%. Well, let's just take 10%. That means you've had to sell $300 million worth of crap.
Mm-hmm. Mm-hmm.
Let's just let that sink in for a minute. And that's assuming everything's sitting on all cylinders. It's actually a little bit more than that because I haven't talked about taxes and everything else.
Right? After taxes in what state?
So it's like exactly right. So let's crank it up another one. Let's just round it up to 40%. So now we're close to $1 billion in sales. I mean, think about that. So you sold almost $1 billion worth of stuff, and now you've got this money. Are you just going to drop that on somebody? Because let's think about it from the investor standpoint. How long did that take them? Well, if they were VC, maybe 5 to 7 years, right? If they had a unicorn like ARC, okay, 5 to 7 years. Start when you're 23, you're lucky, now you're 30. Okay, yeah, you could do it again. What if you're like me? You're not 30 anymore. Dude, I am not giving anybody $1 million in cash without asking a whole hell of a lot of questions because I know I don't have a lot of time on the clock and I'm just not going to fiddle fart around with them.
Well, and by the way, people with that much money don't want a job again.
Well, oh my gosh. I heard this on Shark Tank. Robert, I'm going to butcher his last name. Sorry, Robert. So he was negotiating with the company and they had the audacity to say, well, if we're going to let you in our company, we expect you to work. And Robert, to his credit, just put his pad down, sat back, and he said, I'm sorry, it just doesn't work that way. I'm out. But this is the mindset of entrepreneurs, right? Like you said, I've been working in this. I started in my garage.
Oh man.
Nobody cares.
Well,
Nobody
they're
cares.
like, have you heard this once or 1,000 times? Maceo, this is a great company. I make 400 grand a year. I work 90 hours a week. I have all this risk. I got personal guarantees in my house and my 401k. You should definitely pay me $5 million for this.
Right. Yes. I've heard that quite a bit, actually.
I'll give you 5 million for a job that's 90. Yeah, you just kind of reverse engineer that and just say it out loud to yourself.
Oh my! I had a couple of great entrepreneurs in Dallas. The businesses were not even profitable, and now they came around, but they couldn't fathom why people weren't lining up to pay them $5 or $6 million for that. And so I just broke down the math. I said, listen, first of all, if I'm making $200,000 in profit, how long is it going to take me to just earn my investment back? Let's just start there. And I waited. Well, we don't know. I said, somebody grab a calculator. Let's do it. Like, you're really going to make us do the math? I said, we're going to do the math right now.
Yeah, right.
And we divided it out. And I said, okay, would you on this call invest $5 million to take that long just to break even? Let the pause go until somebody answered me. And finally, they all, one at a time, there's three entrepreneurs, each of them said, well, no. I said, then why the hell are you expecting somebody else to do it? I said, yeah, maybe if you're thinking the greater fool theory or something like that. But I said, this is why your businesses are not going to sell. And then I gave them an offer, for their businesses. And I said, look, this is not what you want. I understand this is not what you want, but this is what you're going to get. And so that's just tough news, man. I mean, because these people had been 25 years, one was 20 years, one was 25, the other one was 30 years in their businesses. And you could just see it from their financials. Like, they had dumped money back in, they had overpaid their employees. Like, oh yeah, we know we have more people on than we need. And I'm like, okay, why would you do that? I mean, I get it, but here's the punchline. At the end of their career, they thought, this is really what they thought. Okay, we're going to invest in our company by paying our employees and keeping the thing afloat. And now they're at the end of the road saying, okay, market, here's my widget, which is their company. Pay me $5 million. And nobody's hitting the bid. Nobody's willing to take them up on that. And so the real tragedy is that the entrepreneurs don't understand where the value is. But this goes all the way back to what you started talking about, is as the entrepreneur, you have to understand where the real value is. Now, is it in your people? Yes, to a degree. Is it in your systems and processes? Yes, to a degree. Your equipment? Yes, to a degree. Your job is to think realistically about, to what degree are those things valuable? So if you're talking about a company where you're thinking, I'm going to have 5 years of a downturn, are you going to get a return on your investment? So sit down, write out how much money you are going to be dumping into your business over those 5 years, and then ask yourself, how much of a return do I need on this cash to make this decision worthwhile to me? And that alone will save many a heartache.
And it kind of goes back to this common theme that I keep saying, that the people that are doing this and moving and shaking right now are operators that know how to do this, the work, but also have the finance to be able to guide their work. It's like the Venn diagram, where you're the little intersection in between, because it's not just spreadsheet junkies that have never fired someone and had their company implode because of it. It's like combination of the two. And I know we're running short on time, like in the next 10 minutes. I'm curious, so when you're talking about understanding the true value, spotting these trends, and then why don't you kind of just give us an insight and say on how this was applied to you selling your business the first time, but also with the current roll-ups that you're doing? Like, these concepts have been amazing, and it's been a fun conversation. But how are you doing? How did it apply to both of those kind of journeys that you've been a part of?
So the good news is I learned my big lesson the hard way. And so this is not going to be good news. So with my e-commerce company, I dumped massive amount of cash into it to build something that nobody wanted. I was way too early. And so, classic mistake. So my e-commerce company, I built APIs into, which an API is called application programming and interface, where basically you're joining up two pieces of you're joining up two computers. I'll leave it at that. And so we had built some of that. We had, built up video players. We'd done all kinds of stuff just to make our company work. And I made the mistake of thinking, oh, well, every e-commerce company is going to love this. $8 million.
A lot of data involved in that statement, right?
$8 million. So when I tell people, write down the number and then ask yourself what kind of return you want. So my return on that was, I'll just say it was very low, and I'll leave it at that.
It
was not
Japanese interest rates low?
it was not a good exit. There are reasons why you don't see tombstones about the exit, and I'm not bragging about it. I'll leave it at that, which is good news, because I'm not talking out of theory. Like I did it and then looked back and said, holy shit, why did I do that? I've made these classic mistakes. And so why the roll-ups? Well, first of all, that company, so 05 to 2012, pretty typical trajectory, 5-7 years. I mean, I could get into cycle theory and all that, but those are usually the numbers. So I started looking at, all right, getting older, how much clock do I have left? How many times can I do this? Number one, like it's work. How many times can I do it? How many times do I want to do it? What do I want to do in my future, right? So I've got to think about it that way. And so if you want to build something quickly, there's no better way to do that than an LBO or a roll-up. You're taking an existing company, you're bolting a bunch of them together, and then you're selling that mass off to somebody, which is usually a private equity fund or a strategic buyer. Now, of course, if you do it right, you can get great multiples. If you do it wrong, which a lot of people don't know, plenty of private equity gets zero at the end of their fund life cycle, because there's no value.
Good luck raising some money on the second round for that.
Yeah, right. Exactly right. They're like, well, we'll do fund number 2. It's like a pyramid scheme. It's like, we'll kind of bail these companies out, and they hide that in the disclosure docs. It's like on page 98. Which, yeah, by the way, if you're investing in something, one of the questions you want to ask is, how big is the fund pocket? Right. So that's basically slang for, if the fund can actually can pocket money, what it means is like fully to the discretion of the GP, the general partner, which means if he's got a fund number 1 that's not doing so well, you might find your money going out to bail out some of those. Learned that the hard way too. So anyway, that's another show. So the lesson learned was, let's go back to the e-commerce company. To do it over with, I would have taken VC money. I would have gone out to Silicon Valley. I would have done the roadshow. I'd have been talking to the Sequoia Capitals, the A16Zs, even though maybe they wouldn't have invested in me, but they would have given me feedback. By the way, it's not going to be a lot of feedback, probably 1 or 2 sentences every once in a while. So that would have helped me refine my pitch, plugging into, Silicon Valley networks and finding out, hey, what are you working on? What are you doing? What are you seeing out there in the marketplace? Do people actually want this? I could have gotten much better coding talent on, and maybe carved out one thing out of my portfolio of stuff that I was trying to sell people, and, made money on that. So, kind of balling all that together, like that's all of those learnings are informing a lot of what I've been saying, obviously on how to combat and not follow in those footsteps, but then also, why am I choosing, the route that I am? So the other reason was, between 2012 and like 2017, so I transitioned back into LBOs in 2017, 2018. I had tried going into companies as a hired gun, so CEO, CMO, to, I'd come in with an agreement for a chunk of equity. It was always, right around 10% to start, with what are called hurdle rates. So I'd have to grow things in order to get more equity, but it was all based on what I did. And I even gave the entrepreneurs, like, look, at the end of the first year, if you don't like what we're doing, you can have your equity back, which is like unheard of, which is another aspect of selling. Like, I wanted to make it risk-free for these entrepreneurs I was working with. And Ryan, I got to tell you, I had one company, I made $8 million in the first like 18 months in sales. Everything was growing and blowing. He called me. He's like, no, I want my equity back. I was like, why would you do that? And so the main reason why I transitioned was like, that was the last straw. Well, no, that's not quite right.
I'm sure
I had one.
A lot of people that went into that.
I make it easy for them. I really do. So I had one more after that. It was another company It was in, I won't get too specific because I'm still under NDA. It was in the consumer packaged goods environment, and came in and said, look, I'm looking to grow something to 2 to 300 million. I'm looking to acquire companies. You on board with that? Yeah, let's go do it. And, it became really apparent over about the first 3 months that this was not really what those entrepreneurs wanted. And I backed out of that one instead of, continuing to go along. So there was one more after that last one. But so what's the moral of that story? The moral of the story is if the entrepreneur doesn't have the right mindset, there's no way you're going to go in and change that, even if you drop millions of dollars in sales on them. In fact, just one of the campaigns for that company, I was spending $250,000 a month on Facebook for like one vertical, and it was basically day 4 profitable. And the guy still booted me, and he killed that project. He just, for whatever, he just didn't like that. He didn't like me. He didn't like my, didn't like my toothpaste. I don't know. It came down to his mindset. He had stuff in his mind about how things should go or the way he wanted things to go, rather than looking at it objectively, like, okay, we're building a business. We're not going to be here forever. Let's build something with some value and sell it off. So I said, you know what? I just need to get back into my own devices.
So, Maceo, I think what's super interesting to me, and I've been trying to almost self-process over the years, as I've gone through my journey to kind of realize the things that you're discussing too, is so there's the mindset, but a mindset kind of encapsulates, if that's the right word, your knowledge base and your emotions, right? So it's kind of like what we were talking about of understanding the technical stuff, but then also managing your emotions, like you're talking about in trading, as well as M&A. Can you help someone shift their mindset, which is kind of some of our messaging, with knowledge and education to say, because it's hard as hell to manage your emotions, man. I'm the first to say, I was sales guy, copier guy, and all the emotional visionary stuff that comes with that. And over the years, I've been able to still be that person, but use data.
Yep.
Keep me in check, I guess.
Yep. Yeah, right.
Style. But I'm curious in how you've seen people. Have you seen people that have been able to make the jump, or how do you personally manage those kind of two dynamics?
Fortunately, there's some practical things you can do. Now, there's a woman named Denise Shull. She runs a trader consulting program, and it's just as simple as this. You can't bottle your emotions up, which for dudes, that's not what we want to hear, right? Now, I'm not saying, now I'm not saying, because I'm a dude, right? I'm not going to cry and, blubber and although I will cry, but I mean, it's I'm just a typical dude. But if you are a guy that cries, what Denise would tell you is then go in your closet and cry. Right. So one of the first things she would work on with the trader is, okay, when you lose a trade, what's your emotion? What's your emotional rainbow? Right. And so you'd have to write it down. So a bit of this is journaling. And it's, all free flowing. So what's running through your mind? What are you saying? I did a lot of recording anyway. So, a lot of it got captured on tape. And so what you might expect being an ex-military guy, mine was, it's not crying. It's at the other end. I'm going to go break something.
Where's the
right. Yep.
I heard power lifter before. So,
Oh yeah. So for me, it's I definitely get, emotional satisfaction if I break something. Right. So I'd have stuff in my garage that I could go break. I would buy cheap aluminum pans. In fact, when my kids, when they were little, they would freak out because I would take a pan and I would bend it. They would, why? Because for a kid, it's a solid, it's really solid, but they were cheap, but I was still kind of strong. Anyway, so it's just know yourself. That was Denise's encouragement, was know who you are and be okay with it. If you're somebody that you need to have a punching bag in your office, which he actually had a client who did, big hedge fund manager. He had a bad trade. He would lay into the punching bag for 5 or 10 minutes and he would be fine afterwards. Give yourself, number one, the freedom especially as a man, to experience, and I mean that, experience your emotions. Don't hold it back. You really want to go until you feel that release. And so this is where women really do have a leg up on us, because man, if a woman needs to cry, she's just going to start crying. If she needs to yell, she's going to yell. With dudes, because we hold that back, that's where we're like, whoa, what? Why are you doing that? Well, she's doing it because that's what she's feeling. Now, you do you want to be circumspect when you do that, right? So I would try and, go into the garage and do all this. My younger son, unfortunately, saw me during one episode. I took a hammer to the top of my workbench because I couldn't find something. And I mean, this is like a 2-inch thick piece of wood, and I busted off like this huge chunk of it. I'm like that. But that's the level. If you do that and you're committed to that, I'm telling you, you will find massive results because you're no longer going to have the after effect. The after effect is where we go wrong because we've got this anger that's bottled up, and that's when it comes out with our wife and our kid and our business partner and our employees. And so this ripple effect in entrepreneurship is what is going to cause the problem.
Mm-hmm.
So, when like if a PE firm is coming in, they see, we've got this loose cannon, he's running around screaming at everybody. That's where they're going to draw back because they know that toxicity is going to infect the company. But from a personal standpoint, especially as men, experience the emotion, don't hide from it. And with some guys that might get dark, I mean, I'll go to some really dark places. And so I'll let my brain do that. And I'll let it do it for a while. And what I'll find is I'll always reach a point where it's too much and then it just fades away. But then I'm good. Like, I'm not snapping at somebody, especially my kids. So if I've got a hard day at work and I know I'm in a bad mood, I'll go take care of it. It's 5-10 minutes. If it's really bad, sometimes it's 15 minutes. So it's committing to that level of work. The next stage of it would be if you're a guy and you got to find somebody. Maybe it's your spouse, but maybe not. You may need another dude that you can, share this stuff with. I'm not leaving the ladies out deliberately. It's just they usually have this handled. I find like they have a girlfriend, they can go talk to. You know what I mean? It's just more. I don't want to say. It's more natural for them. I'll just say
It's interesting, and again, we don't have time for this podcast, but like I've interviewed a lot of very, very successful women on this show, and their leadership and management style is insanely effective to build really powerful cultures because they're asking for input, they're collaborative, it's not ego driven. And again, a lot of generalizations here, but like just themes.
Yeah, for the most part. Yep.
Yeah. And so like to your point, like they've managed that scenario into using your story and your example. It's because you go into a different company or you get to the deal table and all that crap's bottled up. Good luck.
Oh,
I mean, every deal dies 1,000 deaths before you close it.
You're
and
dead.
you're going to be on, issue number 3 and explode.
Yep.
I mean, you can't, it's so, like you said, this world is objective. It's happening.
Yep.
You need to be able to control your reactions to it.
Yeah. So the trader, the way you would experience, so you've got something on your computer screen. The office is totally calm. You can look around, nothing is going on. And yet if somebody had, a heart meter on you, you're sitting there, 120 beats per minute, you're sweating, like the thoughts that are running, just you're in a rage because you saw something happen on your screen. So if you don't have an outlet for that, you are going to make a decision based on that emotional state. And the biology is really clear. When you get, and people call it fight, flight, freeze, that, just know that when you get into that state, you have biological blocks to logical thinking, biological blocks to creative thinking. So you're less creative, you're more impulsive. In the military, we would say you don't rise to a level, you fall to a level. Mm-hmm. And I'm paraphrasing it. So you're going to fall to a level, not rise to one. So if you're at the deal table and you don't have some of this managed, what are you going to do? Like if you're going tomorrow to talk to somebody, if you can't fake that you only speak Spanish and have a translator there, or if you do speak a second language, I would say have somebody translate. This is a very unknown tactic of the Japanese. What the Japanese will do, even if they speak perfect English, is bring in a translator because it gives them time.
Oh, that's brilliant.
So build in some way of getting time into your negotiation process. Like I said, if you're going tomorrow and you haven't done any of this work, you've got to do that.
Or just any decision making.
Well, yeah. I mean, I know a lot of the traders that I studied under, what they would tell me to do is, hey, once you've decided to get on a trade, wait 5 minutes, wait 15 minutes, get up, walk out of the room. I had one that would train me to write a physical check for my loss, but that's all delaying, the decision from the action. because you may make the decision in a mental state that's not good. And so if that translates into the click of a mouse, because that's so easy, they wanted to build in a buffer. And you'll find when you really dig into not system traders like Dalio, but traders that have more discretion, you'll find that they build a lot of that in, where it's not like, oh, I want in and click, they're in it. The ones that do, I'll say this. Sometimes what we think is a born trader or a born salesman is really somebody that through their environment develops certain traits. And you'll find this especially with people that came from abusive relationships. Because they had to manage that abusive relationship, they've got great people skills. So they're very good at looking at somebody and telling what their emotional state is, because that's like the difference between getting a beating and actually getting dinner that night. You know what I mean? And so some of what we observe in the world is really a byproduct of where somebody came from. So the next piece that I'll give people is my personality is geared this way. So for me, it is a little bit hardwired, and it comes from what's called politeness. It's part of the Big Five personality inventory. And politeness isn't please and thank you. It's more giving people respect solely for their position. So I don't care if you put Donald Trump or Joe Biden in my room. I'd be like, so what? You're just a dude. Like, you put your pants on just like I do. I could care less if you're the president or you're, gazillionaire. So for me, I'm able to look past the surface stuff and go behind all that to get to the real story. So how did the deal really get done? How did you really get to be such a good salesman? Because I would endeavor people to do that, like really dig in and don't take people's words for it. Like, again, how do you know that? And based on what? So it's like, well, I was just born a salesman. Well, how do you know that?
Based on what? That is the phrase.
Dude,
yeah, we don't have a lot of time. Yeah.
I've got three. So it's based on what? How do you know that? And it's all math.
Oh, wow. That last part my partner would have. Like, one thing on this planet that can't be solved with math.
That's right.
You're short on time. I need to let you go because you're busy. Maceo, this has been a lot of fun. Two final questions.
Yes.
What does the word intentional mean for you?
Oh, man. Intentional would be the application of will over time.
Ooh, okay. What's the best place to find you and everything that you're doing online?
Well, fortunately, everything I do isn't online because I like keeping my secrecy. My little devious plans. MaceoJordan.com. That is the best place, only because that's where people can actually get in touch with me. I'm very much about working on practical stuff. I'd rather help you make $100 million than give you a PDF.
Yeah, I love it. This has been an absolute joy. Thank you so much for coming on the show.
Good. Glad to be here. Thank you.